Today is Tuesday, April 29th, 2014, and welcome to this week's Money and Market Squawk Call. This is George Lambert sitting in for Mike Bernick. Today our editors will discuss Bank of America's problems, short-term volatility in the market, a possible trend turnaround in Europe, and what's driving the gold and silver market, and finally, what's in store for small cap stocks this week. With me today are Mike Larson, Mandeep Rhea, Larry Edelson, Larry McMillan, and Doug Davenport. Well, good morning, everyone. Let's get started with Mike Larson. Mike, in yesterday's afternoon edition of Money and Markets, you wrote about Bank of America. Can you give us an update on that?
Yeah, sure. Bank of America obviously had a huge disappointment, yet another mistake in a long series of mistakes and problems and lawsuits and so on that have been plaguing it and some of the other major banks like JP Morgan and Citigroup. They came out and were off on some calculations, apparently by a couple $2 billion related to some securities that they inherited when they took out Merrill Lynch as part in a merger back in the midst of the credit crisis, and that caused the stock to have its worst one-day decline. It dropped more than 6%. Its worst one-day decline since late 2012. And the real issue, though, for Bank of America and the rest of the banking sector is that these stocks have all been kind of rolling over a little bit in the last several weeks. We've seen weakness in Bank of America. We've seen other disappointing revenue and earnings reports out of the sector in names like Goldman Sachs and, again, JP Morgan and Citigroup that have put pressure on that. And the breakdown in Bank of America shares, I mean, if you look at the longer-term weekly chart or even a daily chart, you can see Bank of America, it's broken its 200-day moving average. It's broken an uptrend that dates all the way back to last summer. And these are, the summer of 2012. And these are potentially significant technical indicators that the sector, is not really in good shape. And the problem with that is that bank financials had such a great 2013, and they're a pretty big part of the overall S&P. So if you see pressure on that sector, it's potentially going to be another thing that's weighing down on the broader market. And the broader market's already been suffering because of its, the momentum stocks, some of the big names in tech and so on, biotech, that were the hottest high flyers. Many of those names have gotten hit in recent months. So if you're going to lose the banks in addition to some of these other names, it's going to, again, put pressure on the broader market. So I think that's what we got to watch and see, what Bank of America is doing. I mean, they obviously have this stock-specific news with their screw-up in their stress test submission to the Fed, but it's the broader-term technical trends that I think are somewhat troubling there. On the flip side, other thing that I think I would mention just in terms of market activity is that I think that, to me, it looks like the euro may be putting in a significant longer-term top here, multi-month, if not multi-quarter top for the euro and bottom for the U.S. dollar. The dollar index, DXY, appears to be carving out a potential bottom as the euro is topping out. And I think that we may be coming to the end, finally, of the 3-month kind of correction lower in interest rates. Everybody focuses on the 10-year and 30, and it's interesting because of the way that the curve is moving. Long-term yields have been the longest-term yields, like on the 30, have been coming down. The mid-term yields, like the 10s, have basically been moving sideways. And shorter-term yields have actually been going up. If you look at what the 5-year has done, for example, it's very close, within less than 10 basis points, of breaking out to the upside to a new 36, 39-month high, even as the 30-year yield has come down to around 3.5%, which is roughly the lowest since last July. So the curve has been flattening. I think what's very key, we're going to get some data, the biggest economic reports of the month we're going to get on manufacturing and jobs over the next couple of days, and we're also going to have the latest Federal Reserve meeting. Depending on what comes out from that, as well as some inflation data out of Europe, we could see some real fireworks in the market. I mean, again, my speculation, my positioning is that we're going to see the euro break down, the dollar index break up, and long-term yields break up, and short-term yields break out. Kind of those are the sort of 4 moves that I'm looking for that would happen in conjunction with the right kind of data. But again, we'll have to see. The technical setup is there. I believe the longer-term backdrop is there. It's just a question of whether the news cooperates. So that's what I'll be watching.
Okay, Mike, thanks a lot. And Doug Davenport, yesterday you told your all-weather investor members that Europe looks to be turning around. Can you share that information with us today?
Well, I think that I disagree maybe a little bit with Mike, but I mean it's just a matter of timing probably with the euro. The euro's been in a bull market, at least an uptrend since the summer of 2012. And I think when you get in a fight with a central bank, you've got Draghi saying even today that there's not going to be any QE in his opinion, that he thinks inflation is not going to remain low. So any kind of QE that he thinks, and he told that to German lawmakers yesterday, that he didn't think that anything was imminent on that aspect when he has been trying to jawbone the euro back down. But the euro's been in an uptrend. It's right there, 138 to 140. I don't know where it'll go because I don't forecast it, but price action tells me what I need to know. And the price action right now is just saying the euro still is trending up because capital is flowing back into Europe. You look at the equity markets, Spain, Portugal, Greece, Italy, they've all done very, very well in the last 6 months and even 2 years. So Europe's an interesting situation. They're behind the U.S. in growth, but I think that they'll catch up. But maybe they won't have to have QE to be able to do that. And I mentioned about a good friend of mine who's Greek, my dermatologist, and he was in Greece for a month visiting family, and he was talking about how much better everything he sees from talking to his friends and the economy, no more riots in the streets. So who knows? But with the euro could just turn tail and run back down depending on what the U.S. dollar does. And I had worried about what the central bank would do in Europe, but they appear now not to have that on the table. And that's regarding the euro.
Excellent observation, Doug. Thank you very much. Okay, we have.
I was going to say one other thing. We were talking about, Mike was talking about Bank of America up there. You know, the financials did peak out relative to the market since last summer, and Bank of America is a basket case. That's sad to see that. But I think even more important than what they had some issues in compiling numbers is that Janet Yellen, I think, last Friday said that the way that the Federal Reserve forecasts inflation, there's a flaw there. Now, if that's not the strangest thing you've ever heard, that the Fed is having problems with their numbers, and I guess Janet Yellen hasn't meant maybe she hadn't meant to the grocery store where she said to buy, coffee's up 80%, orange juice is up 16%. You've got corn up 17% in beef prices. So I just thought that was interesting that maybe someone else is doing her grocery shopping for her, because if they're not forecasting inflation right, then we have a problem there with the Fed.
Okay, fine. Yeah, who knows where she's doing her shopping. So, okay, fine, thanks. Hey, we have Larry Edelson joining us today. Good morning, Larry.
Good morning. Good morning.
Good.
How is everybody?
Hey, terrific on this end. Hey, listen, what's your take right now on the commodities market, specifically gold and silver?
Well, I'm putting on an issue adding to gold and silver positions this morning. I think they're showing more and more signs of having bottomed last December. They're showing nice action of rallying, pulling back, holding support, rallying again. The cycles are starting to look positive. They flipped this year. We got a cycle inversion process. I think that's due to the cycles of war. And I think they're headed much, much higher, to be honest with you. I'm about to get very, very aggressive in the metals. What's driving all these markets is the conflict in Ukraine and Russia. That's going to blow up. It's not over yet. It's the rising crescendo of the cycles of war that I've been forecasting that march higher all the way into the year 2020. The reason, Doug, I completely disagree with you, unfortunately. The reason the euro is so strong is because the economy is so weak. The euro could get stronger, but a lot of people are going to cash because of the economy. It's underlying. Europe is very unsound, and on top of it all, you got a very real chance of some sort of conflict with Russia. So the first step is to go to cash, which for Europeans means go to the euro. And then the second step is get the money out of Europe, which is already happening, but it's going to happen in spades pretty soon, which is going to send both the dollar and metals higher. As a matter of fact, this morning we're seeing the dollar rallying right along with gold and silver. So there's a lot happening, but it's really driven not by corporate earnings, not by economic fundamentals, but geopolitics, which is what I've been saying all along. everything is going to be driven by geopolitics. You can forget central banks. You can forget underlying stuff like normal fundamentals that we talk about. It's all geopolitical. That's what's going to drive markets going forward.
And this fits in with your war cycles.
Yeah. Eventually you'll see that capital, massive capital, go into the U.S. stock market, which remains very, very bullish long term. In the short term, I expect one more leg down, just one more leg down, probably down to about 1670 on the S&P. And that's it. Then we're going to take off to the upside again. You'll see the dollar rally, stocks rally, U.S. stocks rally, and gold and silver, and other commodities as well.
Okay, excellent. All right, thanks for your insight. And Mandeep, what do you and your team and the research department see for the rest of this week?
Hey, good morning, everyone. So it's kind of a continuation of what we've been seeing over the last couple of weeks, maybe over a month or so, since March, and that's basically shunning some of the high valuations, high growth, momentum stocks, and that brings down the small caps as well. That's the focus of our SUT service. For our thoughts are, it's sort of an environment where having a cash buffer gives you the flexibility, but also insulates some of the downside. It's not if you're overexposed. Maybe put on a hedge or something to that effect until the noise abates. But the Russell 2000 is trading at 10.8 times EBITDA, and that compares to his weekly average since 1995 of 7.7 times EBITDA, which it's a proxy for operating earnings. And if you look at the larger cap Russell variant, the 1000, that's trading at 7.5 times EBITDA. And the smaller caps are trading at a significant premium to the larger caps, and that's where you're seeing a lot of pressure. With this late cycle rally, we have growth. We've had a tremendous year in 2013. We had some hawkish comments that kind of spooked the markets a little bit. Tapering is going to go on as predicted. We have a selling of some of these names, and they're all kind of falling in unison. We're trying to, as a strategy, look at what companies are actually performing on their own laurels. Are either they're cyclical companies, or they're positioned to maintain or increase market share. They're innovating. They're spending on capex. Earnings season gives us a pretty good idea. Pretty good venue to be able to look into the financials a little bit deeper and see if we can uncover some value that still has potential and may have intrinsic value upside. So that's how we're kind of focusing here. We have FOMC coming up. It starts today, and we'll have a discussion by Yellen tomorrow afternoon. We'll be looking for, I think we're going to probably get a rally into that, and barring any hawkish statements, there's one dovish statement from another 1.5% rally over the next couple of days, and we'll see how the market reacts to that. We still have earnings, but if we fade off of that, then the current downtrend that we're seeing in equities may be still very much alive. As Larry was saying, we're at the resistance point, pretty close to it in the SPX at about 1880 or so. So those are some of the things that we're looking at. Europe seems to be stabilizing, but the geopolitical risk, the Russia-Ukraine tensions, that's something significant to look at. And that's going to influence some of the trading volatility upcoming, and it doesn't seem like that situation's abating just yet. So we're sort of cautious here. We're trying to pick entry points. We're trying to play, some of the value plays, and looking for some of the cyclical plays that could have upside. But again, Europe's maybe stabilizing, but China is also a key participant in this wall of worry. We're looking to them for hopefully some more stimulus, try to prop up that growth rate in the mid-sevens. That could bode well if they can construct that for the second half. If all of these situations abate, We still have a low rate environment, even though we do have some rotation, which could be healthy. We could get up to 1900 and beyond. But there's a lot of things there that need to come through for us here. So we're staying cautious.
Okay, fine, Mandy, thank you. Larry, with your options service, you follow the markets very closely on a day-to-day basis. Have you seen any recent signals that listeners should act upon?
Well, the market is directionless, I guess I would call it right now. And we look at volatility and put-call ratios as sentiment indicators. Volatility, the CBOE recently introduced the short-term volatility index, so we've been paying a certain amount of attention to that. And yesterday, it did close above this, which is the first time in a little while. I mean, it moves faster than this, so it closed above VIX, which is generally, there's only a couple of years of backdated price history that you can really use. But generally, that's an indication that the market's going to be more volatile. And it has been volatile, but directionless so far. So it's been great for day traders. Like yesterday, if you could have sold the opening and bought that low, which some people did, I'm assuming, would have been a tremendous day. Today, obviously, with the market back up, looks like it's going to be back up near that resistance area at the top around 1880 for SPX. There's plenty of sellers that keep coming in at this level, so we're looking for some indication from bread or put call ratios to see whether we can get through that area. The put call ratios, we follow two varieties there, but the broad-based equity-only put call ratio is one of them has turned bullish now for the first time in quite a while. And so we're cautious that could be a move there. The thing that would really, I think, turn everything completely positive in our point of view would be if breads were to improve. It's been pretty bad the last few days, and we've seen we follow not only the stock exchange breadth, but we have our own measure of breadth where we just look at all optionable stocks. And that has been fairly weak. It did make a new high local market in early April, but since then it's backed up quite a bit. And I don't suppose it would be too difficult for it to catch up, but right now, we're starting to see a negative divergence there with breadth tailing off, and yet the market's still back at its all-time highs, and that's a bad combination. So for us to really be bullish for an intermediate term, I would need to see that improvement in the breadth along with the continuing buy signals in the put-call ratios. Individually, on certain options, and as you're probably all aware, we're seeing a lot of rumor activity in Allergen and AstraZeneca, but there's also a couple of other ones that you might want to just take a look at as being of interest. One is Tutco Holdings, POM. That's rumored to be evaluating strategic alternatives. Obviously, when a company says that, it's a euphemism for saying we're for sale if we can find a buyer at the right price. So that's just one you might want to keep an eye on as well.
Okay, excellent. Thanks a lot, Larry. All right, thanks, everyone, and talk to you all next week. From Money and Markets, this is George Lambert. Please join us again next week for another discussion on global investing. Have a good day.